So a common question I get, and I think it's just a general confusion across the board, through social media and stuff. With all the people I'm talking to, is what can I actually invest in? And so I know that some people might look at this and be like, yeah, this is obvious, cash and stocks and bonds and real estate and commodities. But I don't think it's all that obvious. And I want to make it very, very clear of kind of how this is set up. And so I know that, in the past we've talked about the layers of index investing, and that's been in previous lessons. So that chart's really important. You pick your broker, you pick your account, and then you pick the asset or like the index fund. And within that index fund, you have like actual stocks or bonds or companies within. So when you're looking at like investments in totality, you have options. It doesn't have to be just stocks. I think stocks are the go-to, but you really have multiple different avenues to go through. And on top of it, there's different investment products for each one of these asset classes. So most people think of cash, and I say cash equivalents because they're obviously equivalent or similar to cash. Is something that you literally just have either physical cash in your bank account, maybe it's in your actual investment account in your money market or settlement fund. I know I've talked to a few of you guys of understanding what that settlement fund specifically is. Cash within an investment account, certificate of deposit. I always call these certificate of depressions. They used to be really good when our parents in the 70s and 80s when the interest rates were really high, but now the interest rates went back down, and of course they're on the way back up. So CDs could become more relevant if rates keep rising. It just depends what banks are going to offer. And then you have maybe a money market account, like I mentioned, or savings bonds. I know my grandma gave me like a savings bond. I don't know when it was, like when I was a kid, and it was worth like $25 extra over the like 25-year period. So it was like worthless. But basically, cash is like a flat asset. And then inflation always enters the market, and then you had to obviously adjust for that. But pre actual inflation, cash is just basically a 0% return typically. But that's something you can keep. A lot of people use this as a buffer, a security blanket. And while there is, validation or, I guess that's could be a legitimate argument, most times you're losing money in cash. So I always keep cash to a minimal. Typically what I need from a day-to-day transactional type thing, monthly bills, and then emergency fund. Everything else I typically throw into the market or an investment of some sort, but that's available. Stocks, often called equities. So I like to throw these like fancy terms around like equities and fixed income and things like that, because I like to make it simple. When people say equities, they just really mean stocks. It's just Wall Street's fancy way of saying things. But think about this: Apple, Tesla, Facebook, or Meta, and Microsoft. Like those are just companies that we have a stake in, we have an ownership in. So when you have equity, you have ownership, and that's the key understanding and also distinction between stocks and bonds. So with the picture right below, I obviously have the same pictures, because with stocks you have ownership, so you're getting a piece of that company. With bonds, it's exactly the opposite. So we're lending these companies, we're still giving our money to them, technically speaking, but we're lending for a fixed rate. So we're going to say Apple, Tesla, Meta, here's, $1,000. You are going to guarantee me, you're going to lend, borrow my money, and you're going to give it back to me, but you're also going to give me a fixed rate of return on top of that. So let's say 3%, 4%. And so they're fixed returns, which is why they're often less than equities and, a lot less risky, but they're still could play a substantial role in someone's portfolio. And then I have a picture of a White House, because sometimes bonds can be like municipal bonds, or like state or local level bonds. It doesn't always have to be just like companies. Then we got real estate. So personal residence, obviously is one of those. Commercial properties, rental properties, but also REITs. So real estate investment trust think of it like an index fund for real estate specifically. So you're basically buying into a fund and a company is operating all the real estate for you, and then they pay out a dividend as a result from their profits that they receive. And that's considered an unqualified dividend. So from a tax consequence, it's always good to have a REIT. If you guys own REITs, which I highly recommend if you are looking into that as part of your portfolio, put those in your retirement accounts, because that's going to be a tax savings instantly of like whatever your tax rate is minus zero. So like if you're a 24% tax earner, you have a 24% tax savings by simply putting that money into a IRA versus like a taxable brokerage account. because when they pay that dividend, it's considered an unqualified dividend. And that's taxed at ordinary rates. So at 24%, you get taxed at 24%. If you simply move that to an IRA, that's boom, that's 24% tax savings right then and there. So that's a huge hack. A lot of people forget about with the REITs. And then you guys have commodities as well. So real hard, assets, gold, silver, oil, things of that nature. And one I didn't list on here, which I I don't know if it's considered an asset at this point in time, but crypto. So I think there's it's a very highly speculative play. But I think crypto's entering the market here soon. It might be recognized as an asset officially here soon by the markets. So this is a little screenshot of, historically speaking, since 1926, kind of the returns of these asset classes. Now, real estate's probably going to be a question like, hey, well, what type of real estate? This is generalized, real estate returns. This isn't like specifically like short-term rentals or long-term rentals. This is just overall. Then you got bonds. So, stocks up at 10-ish%, bonds around the 5% mark, and then real estate and commodities 4-3%. And obviously cash is just flat, but this is going to give you some good insight into kind of the volatility of these asset classes as well. The better the return, the more volatility that comes with it. So typically from, highest to lowest from a return perspective is also the volatility associated with it. So we'll talk about that, throughout the program as well, with portfolio allocation and stuff, and how to kind of align your portfolio with your risk profile. But this is always a good chart to kind of look at and get insight into. All right, so let's talk about investment style when it comes to your portfolio as well. So this is the Morningstar investment style box. And so you might see this if you guys go to morningstar.com, or you might see it on other websites, just like a little box of, nine little boxes within. And they heat up the more riskier they get. So the more riskier the red. So the bottom right's the riskiest. The top left is the least riskiest. So this is the style of investing. So when you guys go look at different types of funds, let's say an index fund or ETF or something, and it says large cap value stock, that's going to fall up here in the top left quadrant, right? So if you go into mid cap growth, so you're all the way over here on the far right in the middle. So you can see the level of risk that's typically associated with that. So when you go look at these funds, it's usually going to give you a 1 to 5 rating of how risky it is, but you can also refer back to this box to see how much risk is truly with that. One investment class, I guess, investment style that I like is small cap value. So that's in the bottom right-hand corner. So it's definitely riskier, but there are pretty solid superior returns to the S&P 500 since inception. And I like that as maybe a 5 to 10% play within a portfolio. That's not to say that's not investment advice. That's not saying everybody makes sense for that. But typically small cap value has actually outperformed the market slightly. And it's got really good returns. So there's obviously additional risk with that, because if you look at like an S&P 500 fund, that would be up in the middle, top middle, large cap value and growth. So you have the, let's say, biggest 500 companies, which is large cap. And then you have value and growth, a mix, which would be blend. But what does the market cap and what does investment style actually mean, to kind of give you some more insight? So market cap's really simple. So all it is from small cap is 0 to 2 billion, mid cap's 2 to 10 billion, and large is 10 billion plus. All of this is, guys, is a calculation. So you can take the share price of any current stock, let's say Apple is $100, times the outstanding shares on the market. That gives you your market capitalization. That's how the S&P 500 is actually weighted. So you guys can go in there and look in the fund perspective, or the fund fact sheet, the prospectus, see what's in the fund itself. And you can see it's weighed by market cap from greatest to least. So that's how they measure that. Then you have the investment style. So value is just low priced stock relative to earnings, and then growth is expensive relative to earnings. And then blends, obviously a mix of both. So an example of like a value stock would be like a CVS. And then an example of a growth stock would be probably anything technology based, something that's really up and coming. A lot of investors are willing to put a lot of money into it. So maybe the P ratio is super high, price to earnings ratio, but it's warranted, even though it's probably well above, a appropriate valuation. So that's the difference between value and growth. When you guys are in index funds, sometimes they lean a little more value, sometimes they lean a little more growth, like VIG and VUG within Vanguard are like large cap growth and large cap value. I forget which one's which. VIG is, let's see which one VIG is. No, that's dividend appreciation. I apologize. VUG, I know for a fact with Vanguard is their growth. So that's right up here in the top right, like Vanguard Growth Index ETF, VUG would fall up here. And what that would really do is pull out from like from the S&P or the total US market, just like the growth that are large cap stocks. And so sometimes people like to lean one certain way based on risk and how much risk they're willing to take on. And this is just a good stylistic box to make that really simple, a simple choice. And I think I've talked about this rule of thumb a few times, but 120 minus your age is a stock percentage in your portfolio to kind of start with as a rule of thumb. But again, it's a rule of thumb, so it's not ideal. But like if I'm 30, 120 minus 30 is 90% stocks, 10% maybe other asset. Maybe we go 10% with, real estate with a REIT, for example, or commodities or bonds. So again, it's a rule of thumb. I'm 30 years old. I have 100%. Well, I have 97% stocks and then 3% crypto. Not saying it's right or wrong, just kind of where I lean myself. Okay, so I'm going to break down tonight the individual types of asset or investment products that we can actually buy using a visual and then just a little bit of explanation. So we have the option to pick the 5 asset classes, right? But within the 5 asset classes, those are different types. They come to us in different types of investment products. So for example, a single asset, which would be like an Apple stock or a government bond or gold in particular, as investors, just think of us all up at the top as investors. We go straight to the institution and we go buy that stock, right? Or that bond or gold. We skip the fund manager. We don't need a fund to take care of us. We just go straight to the source and we buy that. That's a single asset. It's pretty simple, right? Now there's more risk with that because we're betting on one specific company or one specific bond versus, hey, let's just spread our risk out amongst all of them, index funds, ETFs, and stuff like that. But then you have mutual funds. So mutual funds, instead of going straight to the source as investors, we're going to pool our money together and we're going to let this little guy down here control the allocations in that fund. So investment that pools the individual investors' money together with other investors to purchase shares of a collection of stocks, bonds, and other assets. So this is where index funds come into play. An index fund is a form of a mutual fund. So mutual funds it could be anything. It could be actively managed or passively managed, but an index fund is just, a passively managed one. So in this situation, the investors put their money in here. Let's say Kathy Wood, if you guys know with ARK, let's say she's the fund manager here. She's going to charge you, let's say 75 basis points. That's what's the expense ratio. So they're charging you, that's their cost to own the fund. And then you'll get all of the activity that goes through there is going to flow back through you. So if she's trading and buying and selling, there's capital gains and, capital losses throughout that fund. And all of that stuff is thrown back to the investors. That's often a hidden expense that people don't realize about. That's why I don't like actively managed mutual funds. And why I typically will lean index or ETF, because that's on top of the expense ratio and on top of the actual fund for performance on top, at the end. So that's usually kind of sucked out of your account without you even noticing. And then you have index fund, which is obviously the same picture. The difference between index fund and mutual fund, like I said, is just the passive nature. You still have like a Vanguard that selects a portfolio real fast for like the S&P, but it's not too hard to do. So that's the key difference here is like, hey, we just know the biggest 500 stocks we're going to get those. My manager doesn't have to do a lot of work as a result. Therefore, I'm not going to really charge you much. I'm going to charge you maybe free with Fidelity, like FZROX, but with VTSAX might be like 4 basis points. So like 0.04%. So basically a minimal cost, if anything. And since it's an index and it's passive, it's not having all those buying and sellings that are happening throughout the fund. So there's typically no capital gains thrown back to the investor. If anything, it's extremely minimal. ETFs do not have those at all. Index funds do. And I think that's a big thing about the actively managed mutual funds versus the index fund is that secondary cost component of the capital gains kind of thrown back at you. And then we have the exchange traded funds. So the primary difference, guys, between index and ETF are that two main things. One, if you guys go to sell an index or ETF throughout the day, an ETF you sell real time like a stock. With an index fund, it doesn't go in process until the end of that trading day, so 4 p.m. Eastern Standard Time. So if you're a long-term investor, it's not going to make a difference. I personally use index funds. The other component and the reason why I use index funds with Vanguard is because the fractional share price. So with ETFs, you can't buy fractionally. If I buy a share of VU, I have to go check what the price of VU is. I think it's like 190, or VTI is like 198 last time I checked. And I have to buy $198 worth of that. I can't put $150 in there every 2 weeks and just buy one share. It would just sit there in cash until I have at least 198 to cover that. With an index fund, I can go and buy fractional shares, which is why I use the index. ETFs through Vanguard are pretty much the same cost. The passiveness and nature is the same. I don't trade, so I don't need to worry about getting in and out of the market real fast or anything like that. I think ETFs are more built for big broker houses that are buying and selling throughout the day and they need more liquidity fast, and they need to get it off the market at different times. Just kind of a generalization why those products were created, but that's the key difference between index funds and ETFs. Okay, so we were talking about the brokerage with the REITs earlier. So this kind of comes into play here. So when you guys have a brokerage account, that's a non-retirement investment account. I think everybody should probably have a brokerage, but this is separate from your IRA or your like 401k or like 457 or whatever. But you guys will have tax implications in here. That's the benefit of an IRA or 401k. There are no taxes. Once you put the money in, it's tax-free growth. That's the benefit of the retirement accounts. That's why it's such a great account to have. But with a brokerage account, there are different types of taxes. So that's where this is broken down between capital appreciation, dividends, and interest. Capital appreciation is just the increase in value of asset, supply and demand in the market, basically the price of that asset. So if I buy a stock for $200, sell it for $210, my capital appreciation is $10. So you also have dividends, the thank you payments from a company. So the bottom line, the net income, a company's management's going to decide, hey, you know what? Our shareholders, we're starting to become a more mature company, and we don't need to reinvest all of these profits. Let's give a thank you payment to the shareholders. That's a dividend, simple as that. And then you have interest, which is, remember, you give a company some money, you lend them money, and they give you a fixed return back. That's the interest off a bond. So these are all taxed differently. So it depends on the timing of each one of these. So if you are short-term capital gains, so held less than a year, I buy on January 1st Apple stock and I sell it in June 30th of the same year. That's 6 months, right? So I'm going to be taxed at my ordinary income tax rate on the gain of that asset. So let's say I gained $10. $10 that's my gain actually in the asset. I bought it for 130, sold it for 140. $10 is my gain. Therefore, $10 times, let's say 24% would be my tax. So $2.40 would go to tax. The $7.60 would go back to me, or stay in the account. So long-term capital gains would be greater than a year. So their tax code, guys, is incentivizing us to do some sort of thing, own assets and hold them for a long time. That's the short of it, right? So the longer we hold stuff, the less we're taxed. And so we're taxed at capital gains tax rate, which could be 0, 15, or 20%. Typically, it's 15% for most people. It's based on modified AGI. So that's adjusted gross income. And in short, that's $44,000 to for married filing jointly, $84,000 to like $440,000 approximately. If you fall within that income range, you typically are going to have a 15% range. Anything below that is 0%. Anything above that is 20%. Dividends are qualified or unqualified. So like I said, the REITs were unqualified, which is why it's the ordinary income tax rate. But if they're qualified, which is typical of dividends, so let's say your typical Apple or companies that pay a dividend, I don't think Apple pays one, or very minor, if anything. But if they pay a dividend, you're taxed at that same rate, 0, 15, or 20%, typically 15%. And then bonds are ordinary income tax rate. So it's always good to hold bonds in retirement accounts versus like a brokerage account as well, just due to the tax consequence there. Okay, so if you guys want to go open an investment account, I'm going to walk you guys through step by step. This is very simple. So let's say we're going to go buy and get an IRA. We're like, okay, let's get our retirement set up. Let's go step by step. Step one, we go to Vanguard.com and we just click personal investors here. Step two, we hover over what we offer. And then in the accounts and plans, and we click IRAs, and we can select Roth or traditional. Then we just click get started, and then continue a few times, put some personal information in, very, very simple stuff. And then typically, if you're a brand new investor with Vanguard, they might have you mail in required forms. Sometimes they update that. They made my brother do that recently, but it kind of depends. So once you guys get these accounts open and you're like, okay, I'm ready to go, I'm ready to invest, but what does all this mean? Like, this is so confusing. It's really not, I promise. So you'll see a long list of types of investment products. Those investment products are really easy to break down. So I like to think of my fifth grade or English class when they used to do diagramming a sentences kind of thing. That's how I broke down most of these long-winded Vanguard long-term bond index fund, Admiral shares, VBLAX, all that kind of stuff. So oftentimes you guys hear me throw out ticker symbols like VTSAX and stuff like that. That's like a shortened version of what this long thing looks like. So when you get into your investment account, you're going to see all this stuff here listed out, and it might be confusing to many, but let's break it down. So Vanguard is the very first thing is always the broker. So Vanguard, Fidelity, Charles Schwab, it's just going to say their name here. Pretty simple. You usually want to skip to the middle, like what the type of asset is. So whether that be a bond, whether that be a stock, commodity, it's just going to tell you one of those 5 asset classes we talked about in the beginning. So those are always going to be probably one of those 5. Well, actually probably one of those 4, because cash is probably not going to have anything. It might say money market or something like that, or something along the lines of that. That would be a cash equivalent. So that's always the type of asset. And then you have duration and type. Kind of jumping back one box would be, how long is this? Is this a 5-year bond? Is this a 10-year bond? Is this a 20-year bond? Understanding the duration and also the type of asset that you have. And then what type of investment product? So remember when we went through like single asset, index fund, ETF, mutual fund, that's where this will be here. So this is an index fund. So that's the type of investment product. The Admiral share class, or the other thing that it would say is investor share. Now, every single broker is going to be different. So if I'm with Fidelity, this might not be Admiral and investor, but the same concept applies. So the difference between investor and Admiral is investor is $0 to $10,000. So if you have $0 to $10,000 within a specific share, you will be an investor share class, and therefore it's going to be more expensive. Once you get over $10,000 within that fund, it goes to the Admiral share class, which is it's the same fund, it's just cheaper. So you still own the same asset. It just, the more money you give Vanguard, the less they charge you. And then you have the ticker symbol, which is VBLAX here. And that's just the short and abbreviated version. So every time I'm talking to you guys, I don't have to say Vanguard long-term bond index fund Admiral shares. I can say VBLAX. And so that's a breakdown, guys, of the fund, kind of just like a diagram sentences. So when you guys look through things and you're filtering, you could say, okay, I know obviously Vanguard, I'm within Vanguard, so they're all going to say that. I can cross that off the list. I want all index funds or all ETFs. Let's filter the criteria to say all ETFs or all index. That's going to wipe out a ton of options right off the bat. And then you can say, well, I don't want any bonds. Like, I just want, stocks. So I can wipe out all of those. That's going to dwindle your list down substantially. And then you're going to actually come to formulate a list. Okay, here's a large cap growth stock, and here's a large cap value stock. And now I know this, the Morningstar box earlier, I know where I lie on the spectrum of risk. And I can kind of align that with my risk profile, because I've taken my risk profile quizzes and I know what type of person and investor I am. And so you can start to formulate an answer. And this is where you it's a long-winded way to get back to your asset allocation. And there's a lot of steps to this process, but you can start to think through this step by step, and it gets a lot easier. And I want to show you guys on Vanguard in particular. So if I went to Vanguard.com to just illustrate this, here's the personal investor box again, and what we offer and stuff. And here's that IRA picture. But if I went to investment products overview, I can click like mutual funds, ETFs, stocks, CDs, remember certificate of depressions, bonds, or cash investments. So I can initially just go through and select one of these. But if I just want to go to high level, you can filter a lot here. So obviously you can just do CR ETF lineup or whatever, mutual funds, stocks. So it's just a quick way to do it. And if I go to like explore mutual funds, there's going to be like more filtering within. And so if I'm like, okay, management style, I want to do index. I don't want to do active. Like, remember we talked about the fund style, like the really expensive one that we're paying Kathy Wood a lot of money, that would be active. But I'm like, I just want to do index. Maybe strategies, you can add like ESG, which is environmental, social, and governmental. Some people like to invest in that. Quite honestly, guys, I'm all about like environmental, social, and governmental. I think this is a marketing ploy, and I think it's absolute BS. FY. I don't think it's actually legitimate, because I don't think any company is truly ESG. But that's just my opinion. Asset class, you can kind of figure out. Do I want fixed income? Remember, equity and fixed income. We know instantly from this presentation, equity is stocks, fixed income will be like bonds. Then we see money market, which would be like the cash and cash equivalents. Multi-asset would be a accumulation of all of them. And sector and specialty would be the specific sectors of the market. So you would pick like consumer discretionary. So when you the ETF versions, the ones we're looking at on screen are just the index fund versions. But again, we're just breaking this down simply and strategically. There's nothing crazy about doing this stuff. And that's why I think after this program, there's no reason you guys couldn't go out and select your own investments. You can go in risk scale as well. Investment minimums. So you guys know the $3,000 minimum typically. There are some funds within Vanguard that are like 100,000 plus for index funds. Obviously, we're not probably investing in those, but that's why you have so many different tiers and stuff like that. Share classes, remember, investor and admiral, and then also institutional. And they always have like little boxes you can look at as well. And then tax efficiency. So we talked about taxable within like the non-retirement accounts, maybe tax exempt, something like a municipal bond might be a tax exempt thing, and then tax managed. So you can look at those as well and break all these down. You can look at performance. I wouldn't typically jump to performance right away. I think that's fool's gold a lot of times. I think a lot of people jump into performance like, oh, this performed. They go down this list right here and they're like, oh, 12.41. Oh, this is a 45% loss. I'm not going to use that fund. Remember, all of these funds are created at different times. So if you see since inception, it's going to say, hey, this has been around since 2000. This one's been around since 2021. So that's important to note. You're not always comparing apples to apples when you just look at a total return for these different funds. And then you can obviously look at price if you're curious about that, or like investment minimum, price, et cetera, et cetera. Here's our S&P 500 classic VFIX, kind of a heavyweight core one and stuff of that nature.